So here's just a quick update on the Canadian dollar. I had done a previous video on the Aussie dollar for some friends of mine in Australia, and I wanted to contrast that with the Canadian dollar and give you my thesis associated with valuations, etc., etc. This is the American Canadian dollar pair, and my hypothesis is that the currencies directly reflect the future of the country's viability. And I'm going to paint a picture associated with the reasons for why appreciations or depreciations will occur. So in regard to the Canadian dollar, this is a chart which extends back to 83. Unlike the Aussie dollar, to extend it back to 71. This has this currency pair has only existed since 83. Why is that? I'm not particularly sure. Now let me be clear and say that of course it has existed longer, but from the standpoint of tradable volatility, the tradable volatility really began in 83. If you hop online, you'll see, and you can find historical charts back to 71, but America and Canada were very connected, even when that went off the dollar standard because of our proximity. So there was very low volatility, which does stand to reason, and you'll see how this volatility, though, is painting a picture for how things are going to play out as we pull into the future. So let's go through it. So, interesting thing to note here is we have what's called a head and shoulders pattern. We have, again, if you're not familiar with what a head and shoulders pattern is, you can go online and Google tradable patterns, head and shoulders. And a head and shoulders pattern is a bearish pattern for the decline of a particular asset. In this particular case, the decline of the American dollar. So we have a head here, a shoulder, and a shoulder. And what does that mean? Well, a head and shoulder pattern basically means that the market rises up, tests a point, falls, rises up, tests a point, but then exceeds it, but then can't hold that point, then falls and rises back up and retests that point, and then all that's left. Objects in motion tend to stay in particular motion, and all that's left is a bearish continuance. So I'm going to eventually take us to this chart here where you see everything. I'm going to show you how we build it. So first thing we're going to do is we're going to draw a trend line. I'm going to draw a trend line to these points of contact. Okay. Now there is an overshoot here, and yeah, sure, you could draw a trend line like this if you wanted. More often than not, though, you'll find in trading, there usually is one overshoot because that's what's called impulse. So I'm going to, again, go with this thesis and you'll see what I'm talking about here, okay? So establishing a trend line is that, so let's pretend back in 2007, 2011, you decided to draw this trend line, okay? And you then would create a duplicate of this trend line. And you'll notice something magical is going to happen. Watch closely. Isn't that interesting? So because of that, the first part of our thesis is that this is the trend. Okay? Now these lines you see here, they are the 50 and the 200-day moving average. And anytime you experience what's called a cross in these, it indicates a change in the market. So for example, you had a cross here way back in 91, and sure as shit, went straight up, and yeah, sure, it retested these. This line becomes support, and support when it's on the other side of it, resistance and on the other. Blipped under here for a bit, had a little bit of indecision, but just kept going. Okay. So we had a cross here, and this caused the collapse in the market here. We had a cross here, caused the rise. We had a cause the rise. This would have been a bit hard to trade. This happened right around 9/11, right? So, it's or not 9/11. There was a conflict, I believe. Yeah, this is the financial crisis. Excuse me. In when the first leg of things that are going south. So you notice this cross here, and then again, once again, oh yeah, lots of excitement, a little more support, lots of excitement, and uh-oh, there's that cross. Okay. So the first thing you want to pay attention to is all this space that's down here. None up here, all this space is down here, and objects in motion tend to stay in motion. Okay. So what does that basically mean? Well, if you refer back to the other chart I showed you how you can measure a chart, you can measure a chart with just looking at the overall price action. So I'm just going to measure this down and take this crude tool, this arrow, and measure it to here. Okay, so you'll notice that the arrow goes to this point to 90.60. That was the low there to $1.62. So at one time, an American dollar cost Canadian $1.62, and at one time it cost a Canadian 90 cents, which is in itself pretty insane, but it is what it is. But go back to what I told you earlier about the macro measurements, okay? And you can see at about 20, going back to what I was saying about the Aussie dollar losing parity against or losing quite a bit of value against the American dollar. Well, you can see that roughly by after 2030, by about 2034, the American dollar is going to be worth about 74 cents. Now, could it happen before? Sure, it could. Let's take a look at the other chart to show you what I'm talking about. So, here we have a mini version of this bigger version, okay? So this arrow that I showed you here a second ago, okay? Let's do it again. Now we're going to take this little pattern here, okay? Draw this down to here, okay? Now, before I go any further, you'll notice that this right here is what's called a double top, okay? Now a double top is it's basically, in logical terms, this is where the market has tried to rise past this price point one time, then twice, and could no longer do it, okay? And so what you have here, and this is exactly the Fibonacci extension of 78.6%, which in trading terms, once it hits that twice and doesn't advance past it, lights are out, okay? So my point is that, so we look back at this arrow here, which is the bigger pattern, right? But then we also have the smaller pattern, and the smaller pattern works like this. See, we're going to take this here, and we're going to draw that, and measure this exactly, okay? We're going to measure this exactly, and we're going to see this right here, and this is going to take us back into this brouhaha down here, okay? And you see this happens over and over again. Look at it here. If you hop back in a time machine in 2016, if you'd measured this here, and then you'd measured this here, one moment. Let's try and be as accurate as possible. Okay. We hit the support level that I was telling you about in regard to the 50 and the 200. But you'll see that we are now officially well underneath. We're well underneath the 50 and the 200. And so what does that mean? It is easier. We have these two tops right here. It is easier for the market to fall apart and simply continue down. And this will take us into this, back into this area here. This area here becomes, remember what I was telling you about floors and ceilings? Okay. This area here, right here, is a floor, so it's probably going to come down. It's going to bounce here. It's going to jerk around for a bit. Probably come back up, retest about here, and then it's going to continue, and it has to get through all of this haze that's in here, and it'll take a while to get through this haze. And what I mean by haze, well, again, you're going to have a situation where it will likely come down, and it'll test maybe this level here and jerk around. What does that look like on a macro level? Well, you see, this is the radial, okay? So I've spoken of the radial before. So if we just zoom in here on this radial, okay? You see, we're almost at the tipping point because we've incurred the radial here and here, and we're under we bounced up against the 200-day moving average. And so very likely we're going to come down, hit the radial here, bounce up, jerk along this, and then once we're past this point, which takes us into later in 2022, it's basically clear sailing. We are very likely going to encounter this trend line right here. And I'm just going to accentuate that just a little bit. Okay. Very likely going to encounter this trend line here, and then it'll jerk around in here for a bit, maybe come up, maybe retest this level. But ultimately, we're all looking at this decline to testing the 94 cents. And then ultimately, as I said, if we observe the trend line, which there's just sort of some unwritten rules in trading about how things are going to go as far as measurements are concerned. So all I can really say, whoops, hang on here, is that if you want to put your money someplace safe, the Canadian dollar would be a good place to do it. Now, what does that mean? Why is the Canadian dollar going to do better than the Aussie dollar? Well, for starters, America has a problem with oil and their money. So there's already saber rattling in Saudi Arabia and other oil-producing nations. And it is true, and there may well be a situation where the Saudis just decide they don't want American dollars anymore because they just can't do anything with them. They very likely will be fueling China, who will just be China's growth is going to China and India's growth is going to be exponential, and you know they've got a population that is full of largely healthier people than America, more production, etc., etc., and all those areas are simply going to be in a situation where they're like, you know what, we just don't want your oil, or we don't want your money. We're going to sell our oil to people whose money is actually worth something. So in Canada, we're America's largest trading partner, and we've got these giant oil reserves that are ready to go. And so, all the pipeline projects you heard about in the past, they're going to start up. And so America will basically, even though they're essentially going to coerce Canada into be like, well, you have to sell us your shit. And, we're a close trading partner, et cetera, et cetera. So, that's essentially what's going to happen. America is going to lean very heavily on Canada because we're right here and we got all. As to whether their money is useful for anything or not, I mean, yes, in North America for general trade and stuff, yes, but really, at the end of the day, there's not a lot of stuff that America makes that, like, America's manufacturing is going to fall off a cliff because components will be an issue. Now, all these things can be remedied by productivity in the manufacturing sector as far as repatriating stuff. But that does not happen overnight. And so, as I said, it'll be easy for Canada. As compared to the American dollar, the Canadian dollar will just eviscerate it because they'll just be paying us. They'll be paying us more and more with their inflated money. Now, as compared to what I told you about Australia, the problem with Australia is that although they are a resource-based economy, they're largely going to, after the conflict in the Pacific, they're largely going to be shunned. Like, China just won't want to deal with them. They're sure they could buy stuff from Australia, but they'll just buy it from the Saudis or someone who's geographically closer to them. There just will be a demonization of the West in general, and it'll just be like the worst form. Let's face it, the world is run by narcissists, and narcissistic people love to ice people out, and they'll just ignore them and just find new sources of supply. And so I think the combination of Australia having an issue with that whole conflict and with the population and with their failed leadership, I think that's the isthmus for the reason that the Australian dollar is going to fall off a cliff, as proven by the charting I did in my previous video. Whereas in Canada, we're largely going to be puppets of America, but the one thing that'll be overwhelming is the value of our currency versus theirs, because they will pay us. They will pay for Canadian goods with money they print, which will basically cause more supply for them of their currency, vastly more than in the Canada has. So it'll be good for Canada. As to how the rest of the world is going to interpret the way those currencies are going to work, because it's very large. It is very likely that the Eastern countries may stop accepting. For sure, they're gonna. There's. I bet my left nut that in the near future, the American dollar is not going to be widely accepted or accepted at a huge premium. As to whether they'll accept the Canadian dollar or some resource-based backed currency, that's undetermined. But bottom line is, if you're wondering where to put your money, the Canadian dollar is one good place to consider for the reasons I showed you. But the real winner will, of course, be the Russian currency and the yuan, which I will show in a video coming up shortly. So, yeah. Thanks for watching.